Welcome back. It's time for The Big Picture. I'm Alex Coffey, and I'm now joined by Ann Sonders, the Chief Investment Strategist for Charles Schwab, as well as Cooper Howard, Director and Fixed Income Strategist for the Schwab Center for Financial Research. Good afternoon to both of you guys. Cooper, I'm going to start with you because the big story today, even though it doesn't look as big today at this point as it did this morning, is this Moody's downgrade. This is right in your wheelhouse. Exciting times for credit.
You know, I don't think it's an exciting time when the U.S. debt is downgraded. That's obviously not good news. And like you mentioned, it is news, but I also think that it's notable that it's not really news. This was something that in terms of the market's perspective wasn't largely a surprise. They already got downgraded by Fitch, S&P, so Moody's was the last one on the bandwagon to join in downgrading the U.S. debt. Also, if you look at the market's response, Alex, really, they're taking it as kind of a non-event. Obviously, the trajectory of getting downgraded isn't great. With the deficit increasing, that's not a positive. I also think the timing of it is a little bit of a surprise in terms of it coming out noting the tax bill, but ultimately the tax bill hasn't been passed. So longer term, I don't think the trajectory of where we're going with the U.S. debt is a positive. However, in terms of the market's response to it, it's largely coming up as not a big surprise.
Ann, I tend to agree, I think, with Cooper in the sense that the market's shrugging this off and it's been kind of a non-event, but it also highlights that the buy the dip crowd is back. I mean, we were under a little bit of pressure this morning and it lasted all of a couple hours. Do you think that's emblematic that the worst might be behind us?
Oh, I don't know. I think the market is still at the mercy of headlines in both directions. I think the one way to think about this is the setup and then whatever the trigger is. So you get setups by virtue of getting to, technically well oversold conditions, like was the case in the early part of April. Sentiment gets washed out, and that's the setup. And then you get the headline that came on April 9th in terms of the delay in the so-called reciprocal tariffs. Now we're in not completely the opposite direction. We're not at the extreme of overbought conditions as we were the extreme of oversold conditions back in early April, but we may be getting to a point where you get the setup that if you get some sort of negative catalyst, and these days you can assume that it could come from a policy perspective, you have that setup that could mean you have a bit of a move down in the opposite direction. I do think the buy the dip mentality is still very much evident. I think you see that when you see the nature of what has done well, where leadership has resided off the intraday low on April 9th. It's been in areas that are deemed retail favorites. In fact, Goldman Sachs has a retail favorites basket that has outperformed the S&P. You've seen the meme stocks outperform the S&P, non-profitable tech outperform the S&P. So it's been that retail trader bias to the lift, plus heavily shorted stocks have done very well. So short covering on the part of many institutions. So that's been the flavor of this rally, but we could now be at the mercy of any possible negative headlines.
I love the discussion on the sentiment. I always kind of describe it as a pendulum. It overswings in both directions. And, it's sort of the ebbs and flows of the market that keeps things, exciting and interesting on a daily basis for us. But Ann, you talk about this, the retail buyers, the buy the dip and all this. And I think it's notable, especially, some of the things you talked about, the retail favorites outperforming, short covering baskets outperforming. At some point, if those negative headlines don't come, though, do institutions have to get back in, and is that potential fuel on the sidelines, or is it overstated how much they actually rotated out?
Well, yeah, short covering does suggest that there were some positioning changes, and not just at the low, but heading into the low, you saw a change toward more bearish positioning by speculators in the hedge fund community and the CTAs. There's probably, I think the pain trade, as it's often called, is probably still more to the upside than to the downside. So yeah, I don't love the cash on the sidelines because, for every buyer, there's a seller. But could there still be some pressure on the upside by virtue of positioning change from institutions? Yeah, I think there's validity to that.
As Ann said, Cooper, we maybe are subject to trade policy headlines, and we continue to be and have seen that so far in 2025. But notably this week, especially given the fact that economic data is super light, earnings are relatively light. But one thing that isn't light is the Fed speaker calendar. What's your thoughts on what we might hear this week from, 17 different Fed speeches throughout the week?
Yeah, you're correct. We get 17 different Fed speeches this week. And I largely think that they're going to be preaching from the same kind of mandate, or the same kind of Bible, if you will, excuse me. And that's likely going to be one of patience. We've already heard from Bostic today, and he's suggested that maybe we'll only see one Fed rate cut this year. And I think given kind of what Liz Ann had said, that there's a lot of uncertainty, especially around tariffs. We're being driven by a headline policy right now. The markets are being driven a lot by headlines. Ultimately, the path of where we go forward in terms of what happens with the labor market, what happens with inflation, largely a lot of that is going to be dependent upon what is the tariff policy, what is the trade policy. So for the Fed's perspective, ultimately, given that the path is pretty unclear right now, I think it's appropriate to stay the course, continue to be patient. And I think that that's ultimately what you're going to hear from many Fed officials this week, Alex. Right now, if you look at where the market's still betting that we're going to get about 2 rate cuts prior to the year end. I think that that's probably appropriate. I think if we start to see a slowdown in the labor market, and so far the labor market's been relatively steady, we haven't seen too much of an uptick one way or another. So it's really been kind of a no hire, no fire labor market. But if we start to see a slowdown in the labor market in terms of an increase in the unemployment rate, maybe that causes the Fed to move a little bit more aggressively than the 2 rate cuts. But given that there's a lot of uncertainty related to trade policy, I do think that they're going to stay on pat for the time being.
With about 3 minutes to the bell, we're just over the unchanged line. But Liz Ann, final question for you. I think we all agree trade policy headlines seem to be the primary catalyst. What's next? Even if it's a distant second, is it earnings? Is it the Fed?
I think it's probably the labor market. And that, to me, that's clearly what's potentially next from an economic standpoint. And that feeds into companies as well. But I think because right now, anyway, inflation is not spiking here, tariff related or otherwise, which allows the Fed to have a little bit more of an eye on the labor market. Labor market also is a signal in terms of how companies are dealing with the trade war and tariff related uncertainties. So far, the discussion from companies, we heard this throughout the course of earnings season, is on maybe experimenting a little bit with what price increases might stick. So how much of those costs, both those that have already incurred and they need to come, can they pass on to the consumer? How much might they eat that in profit margins? And to the extent it's eaten in profit margins, are we still in that, to Cooper's point, no hire, no fire, labor hoarding kind of backdrop, which saved the economy to a large degree in 2022 and 2023? Or at some point, if there's a profit margin hit sufficient, that they have to start addressing it on the labor market side of things. So labor market really holds the key here.
Liz Ann Sonders, Cooper Howard, thank you both.